Good morning and welcome to Mega Capital Funding. We are delighted to have you join us today as we explore innovative strategies and insights that can propel your business forward. Our session today is designed to provide you with valuable knowledge in the non-owner occupied and second home space that you can apply to achieve success in today's dynamic market. We are excited to embark on this journey of learning and growth with you. Thank you for choosing to spend your time with us today. Let's make the most of this opportunity to share, learn, and inspire each other.
Well, hello, everybody. Sorry I'm late for my own meeting, but I couldn't get in. So technical difficulties. I apologize for that. So we're going to get started here and get going because I know everybody's time is valuable. So my name is Ed Darrow. I am the National Sales Manager for Mega Capital. Also joining me today is Kevin Maureen, who is my Regional Sales Manager out on the West Coast, out of California. Kevin may wave here in a moment just to say hi. I don't know. But there's Kev. You got to take himself off mute, but there's Kev. So we are going to get started and try to roll through this. We originally started this as a just a non-Q or a non-owner occupied agency expanded program, which we will get into in a few moments. That is a new opportunity that we rolled out, but we decided that we are going to add a few other items into this that we are going to kind of show you and go from there. So right now we're running two specials that we want to remind everybody about. On our non-QM side, we're running a eighth point special for anything that is submitted to us over the next 9 days and closes by the end of the year. And then we're also running, go ahead, Mel. We're also running a holiday special, any conforming max or AG end loan between 100 and 250. We're giving you a quarter price incentive. It's got to lock by the 20th at the latest and close by the end of the year. So we're excited about being able to give a couple of different specials and go from there and continue to try to help everybody. But we wanted just to remind everybody about, straight up agency, second and non-owner. Just, I'm assuming everybody knows this. We'll kind of fly through this, but it kind of helps us differentiate between this and the expanded. Go ahead, Mel. So obviously, do you approve 90% on one unit for second homes, 75 for cash out. Investment is 85 for 2 to 4 units is 75. And this is just straight up, Fannie Mae 1 to 4 units investment rate term is 75. And this is your standard Fannie Mae numbers, right? There's no difference there. The big point about this is that these are going to be important with the expanded in so much as that the LLPA hits for Fannie on a regular agency is rather daunting, right? And when we get into the expanded, which is our next one that we're going to talk about, is that we mirrored Fannie Mae guidelines in regards to what is required for a second home or investment property. A couple things about this is obviously we need a DU approval, max to 50, 30-year full doc W-2 self-employed only, right? So this is not a non-QM program in the sense that we're using alternative ways to qualify. But what it allows us to do is to get to those particular second homes and investments and allow us to go into not a big as an LLPA hit. So as you get up the rate stack and you go from a 101 to a 101.5 to 102, our pricing gets extremely aggressive in the agency investor expanded program. Go ahead, Mel. So the difference here is we put in a floor at 150 where our normal Fannie Mae product is 75. So there's a little bit difference there. Obviously, your max is your Fannie Mae limits. And we put in a floor where our standard Fannie Mae conforming will go to 620. The bottom here is 660. So it's a little narrow of a window compared to the straight up Fannie. but it gives you the opportunity to do the same type of program, and allow and not maybe pay quite as a severe price for the Fannie Mae LLPAs versus this program. So it's given us a little bit of leverage into that space and allows us to offer our brokers the opportunity to um, look at both ways. What works? Now you may have a 620 that you have to go Fannie Mae and pay the LLPAs, but if you've got a 660 or better, this is just something we wanted to point out to you as an opportunity. Again, 30-year fixed, 50% DTI max, 150 or better, but gives you an opportunity to get a little better price. So same thing here, second home, one unit, 150, 660 bottom, cash out, 775 LTV. Again, the win here is going to be in the price point, and getting up the rate stack, and go from there. So we just wanted to make sure. So there's no the reserve requirements are per AUS, no prepays, no buy downs, no non-traditional credit, and we have to have an appraisal. So again, nothing different than you would really get into on a true Fannie Mae loan, right? So just an opportunity for us to give you a better price and then go from there.
Ed, maybe I'll jump in real quick because I had some observations on this and tinkering around with some of the competitive pricing survey tools that exist out there. And realistically, this mirrors agency guidelines, just like Ed has pointed out. But many of you guys have been pricing out loans, and you notice when you get to the top of a rate stack on a conventional agency loan, you start to run out of premium, right? And a lot of that is behavior designed by the agencies and so forth with prepay speeds. The higher you get up into a note stack, they feel that you might be in the money, and you start out to run out of room on that spread between note rates. This product knows that it's a second home, it's an investment property. It's not going to be immediately in the money if rates drop down a smidge. So it pays up a higher amount up at those higher note rates. And so we've got investors that are anxious to have that product. They know the prepay speeds on these are not going to be high, and therefore allows us to give us a little bit more aggressive pricing in the note specific that we see in the second home and the investment properties. So just wanted to add that.
Great observation. Appreciate it. And Kevin and I'll go back and forth little things that he sees or doesn't see. So when we originally were going to do this, we were just going to kind of stop there, and while your time is valuable, we would have been over here in about 7 minutes. So we thought we'd take the opportunity to look at some other things that we do in the non-owner and second home space on our non-QM side. So Fannie and Freddie, standard Fannie, standard that. The expanded, we kind of went over. And again, that's going to be a price point play using the floor and the higher. Here on the non-QM side, you get away from the traditional, W-2 tax returns, pay stubs, and it gives us the opportunity to play along in different spaces. So this one we're highlighting is bank statements, and that goes to 80. Written VOE is to 80. P&L is to 80 on a purchase and rate term. Cash out is 75, 70, and 70. So if you look at full doc bank statement at 1099, you can go to 80, cash out to 75, max DTI 50. But it gives you different opportunities to get into the space, right? So you're still at a 50 DTI, minimum FICO 660, but now where you take the transition here in the non-owner second home space with the non-QM is you start to get into bigger loan amounts. So where you're not confined to Fannie's limits for wherever you are at, this gets you into the $2.5 to $3 million range, and allows you. Now you can still do a full doc 1 year, and get to that 3 million if you've got a. So if you're playing on the coast, you're in an area where it's a resort area, whether it's Colorado, whatever the case may be, you have that opportunity to do so. The other thing it allows too is an interest only product. So when you're trying to figure out what's the best way to go, just another way to skin that cat, and get to where you need to be. So um, the little footnote at the bottom, in our non-QM space, we also offer asset utilization. Where most people are thinking kind of asset depletion with Fannie and Freddie, this is slightly different. But if they're rolling around with more than $1 million, or they end up with 1.25 uh, percent greater than, with reserves greater than what they use at the time of the loan closes, and there's no other opportunity, for the non-owner, you can go 65. So if they have a lot of assets, but maybe they're retired, not working, maybe, in between jobs, but they've got a lot of money. There's opportunities for us to be able to use their assets in a non-owner occupied space and still give them a 65 LTV. So if you're playing with a lot of equity, I looked at one the other day, and we were in the 50 LTV space. They had a ton of equity in the product, or in the house, and it gave us an opportunity to do so. So a couple other things that I think are unique in the non-QM space. They do allow for gifts, especially on second homes, where you may not necessarily do that, with no minimum borrower contribution required. So little different than the straight up Fannie side, and it gives you an opportunity to, um, use the gift in a second home situation where normally it always has to come out of the borrower's funds. So. The next one, and again, in the investment space, obviously, is going to be our DSCR. So we lean on our MVP DSCR, but we have three, kind of buckets that go into this. Um, it's actually a fourth from a pricing side, but for a guideline, it's greater than one, um, down to 75 to 1, and then a no ratio below that. So you have this opportunity to go 80 or 75 or 70, and play this all the way through 75, 70, and 60 for cash out. You've got some restrictions in regards to, your FICO look. 660, if you're greater than 1, you're at 720. If you're less than 1 to 75, and then in the no ratio 700. That might be backwards, but minimum loan amount 150. Max loan amounts are going to be those 2.5, $2.5, $3 million number. The no ratio is capped at 1.5 million, and then the reserves are 3 and 6. So where this obviously plays is, again, if you've got this opportunity for an investment property, and it just kind of depends on how the ratio goes on where you can play. Our biggest thing is to make sure that, we have an opportunity for you, whether the DSCR ratio is less than 75, which we put in our no ratio bucket, and then we run pricing all the way through 1, and actually 120, where we give you more of a pricing bump. So a big range that allows the DSCR. Allowed, gift funds are allowed, for purchases only, from a family member, and for down payment and closing costs only. But again, you're in a space where if you go to the Fannie side, they want to have all the money come from the borrower. For the most part, here you can get a gift from a family member for all the down payment and closing costs. The borrower would have to make sure they put up the reserves. But it's a lift, right? It's just a lift that you can play with, in this non-owner space, that may be different than what Fannie and Freddie allow. So we're kind of doing these webinars in a short kind of space span, right? We want to keep them short and sweet. So we'll open up for questions. We know that 15 or 20 minutes of going through something, doesn't give you a full picture, but it does give you an idea of what we can do. and then we wanted to leave the last, 5 to 10 minutes for any questions that anyone may have about the programs that we went through. So if you want to take yourself off of mute or chat, put something in the chat. I'm sure Mel can bring it up for us, but let us know if there's any questions that you may have. If you do, take yourself off of mute and we will answer whatever you might have in regards to anything that we might have covered.
Can you hear me?
Yes, sir.
Hey, how you guys doing?
Good. How are you?
Good, good. With any of our lender partners, whenever I'm pricing out a non-QM opportunity, I usually just go to their website because of the uniqueness of the situation. As far as the first half of the presentation with the expanded product, are we able to see that pricing in Loan Sifter, and if so, when?
It is. It's in there now. It does work.
Interesting, because I ran it while we were chatting and I didn't get pricing on a scenario, but maybe I ran the scenario wrong. It's normally user error in my case, but I still want to.
Usually with me too, but I was able to run an expanded the other day, and it did work. So
I'm gonna try it again. I'm gonna run like a second home scenario, but go ahead. You can answer anybody else's questions. I'm just gonna play. I'm in Loan Sifter as we speak.
Yeah, and Christopher, try and drive it up into the higher note rates. If your scenario is such that you're in a low note rate, in some cases, our regular agency priced better in Loan Sifter than the expanded. But once it forces you up into the higher note rates, so if whether it be a lower FICO, um, higher LTV, that's where we were seeing that fire, and it jumps up fairly substantially. Prices better than our regular agency loan. And failing that, get together with your account executive, have them shoot us an email. We'll shoot you on over a Loan Sifter and show it triggering.
Okay. Thank you.
So yeah, I just ran one, Chris, and it did fire. I did an investment at 80, and it did fire. So it's there. It says agency non-owner, expanded 30-year fix. So it does fire. And then you can kind of play from there and see where you go.
What's the loan amount entered?
I did 600 on 800. I did a 75, I did a 720 investment in Florida, but it will fire. So, and then you just kind of figure out from there who's playing and who's not. So what else can we answer for you?
Thank you.
For those folks that are pricing it off our pricing engine, for the expanded agency product, you're going to be looking for the product code called ANX 30, or in the case of a high balance, it'll be, I think it's ANX HB, but that's the product code for that product.
What else can we answer for you guys? We know your time's valuable. We just want to make sure we've added a value add to you here. So is there anything else we can answer for you, whether it's DSCR, a bank statement deal, anything like that, or have we covered pretty much what you had there? What can we answer for you?
I'll ask a loaded question for you, Ed.
There you go.
Is DSCR products really your easiest product to qualify on an investment property? And if I have no experience with DSCR, what's the easiest way for me to get a good understanding on the product?
So to me, it's the easiest because it's the least amount of work for a broker and a consumer to get into. I think a couple of the challenges that you have with DSCR is making sure whether or not you have a first time investor or not. There's just some small rules around that. But I think it's really, really simple. I think the easiest way is figure out what your rent roll is and see what your PITIA is. And if it's 1-to-1, you're good to go. And if it's less than that, you've got to look for investors that do a no ratio or less than one. Anything greater than one, you'll find somebody to do. But it's really just, figuring out your rental income versus your PITIA. You know, and as far as a resource, our guidelines are posted out there, www.mcfunding.com for everyone to look at, and you can kind of go through that. And then your AEs are a great resource to get everybody up to speed on what you need and where you need to go from there. So hopefully that answers the question. Thank you for the loaded. Thank you for the loaded softball.
I just sometimes people are a little nervous or apprehensive of DSCR. A lot of people are familiar and comfortable with them now. If you've never done a DSCR loan, reach out to your account executive. They're extraordinarily easy. And again, they just purely and simply look at the cash flow of the property. Is it a positive cash flow versus the obligation? And then you have a ratio over 1. If it has a negative cash flow, then your ratio is under 1. But don't be nervous and apprehensive if you don't have familiarity. Reach out to your account executive. They're an extraordinarily easy program to qualify a borrower on.
Absolutely. So, well, any other questions that you may have? All right. Well, we thank you for your time. Again, it's short and sweet. We know your time is valuable. We won't be having one of these again until probably mid-December, so we won't get to see you. So happy Thanksgiving. I hope everybody has a great day and get a chance to relax and eat some turkey and whatever our other favorite things are, and we will go from there. So again, thank you everybody, and happy Thanksgiving from Mega Capital. Talk to you later.